Deferred capital gains invested in a qualified opportunity fund don't stay deferred forever. They eventually come home to roost on the deferral date of December 31, 2026. And the resulting tax comes due with the Opportunity Zone Investors 26 return in April 2027. But how much of that deferred gain actually becomes taxable? Well, it all hinges on one critical figure, the fair market value of the OZ investment on that final date of 2026. In today's episode, I'm joined by real estate attorney Brad Molotsky of Duane to break down FMV calculations, appraisal best practices, and the steps investors and fund managers should be taking now to get ready. Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Brad Molotsky is a partner at Duane, where he serves as co-head of the law firm's Opportunity Zones practice group, and he joins me today from Philadelphia, Pennsylvania. Brad, great to see you. How you doing?
Great to be seen. Thanks, Jimmy. Pleasure to be on the call. It's a little warm out, but we're inside, and so it's all good. How
Excellent. You doing? I'm doing well. Great to see you on the call. As always, you're a frequent visitor on a lot of the webinars and OZ pitch days that I host, and I think I named you the VIP of the last one that we did back in June because you had so many great comments and questions. So thank you for always being super active on those.
Absolutely. Some would say annoying, but super active. I appreciate. So it's all good, man. I love those pitch days. It's great. It's hard to, as you know, it's hard to get information about different deals going on in different parts of the country. And so I think the pitch day is one of the few places where people can go and learn about whatever, 8, 10 different deals going on and what those deals are about and what the returns are and what, the investors or at least the developers are looking to put together. So kudos to you and the team and keep that going.
Well, thank you. And yeah, we are going to keep it going. Our next one's coming up in November. Our registration will open for that one before we know it. Brad, I want to talk about fair market value and the 12/31/2026 deferral date with you in a moment here. But first, who are you and what brings you to the world of Opportunity Zones? Introduce yourself for us.
Someone said I look like your older brother. I don't know. I don't think
a little bit, yeah.
Yeah.
If I had an older brother, it would be you probably.
Yeah, so you're a very handsome man. I am a real estate transactional person. I've been doing that for 35-ish years, worked at a big firm, was doing M&A deals and real estate deals. One of our clients, a REIT, said, hey, you're doing stuff with us. We're getting bigger. Come work with us. So I left the big firm a long time ago when you were probably in grade school. 1998, went to the REIT. We bought land. We built buildings. We leased them. We managed them. We JV'd them, raised public debt and public equity, and had a good time doing it. They're good people. They're still doing their thing. Left there about 10 years ago, came to Duane, my older guy, who some have seen online. He is a special needs guy, so I have 3 kids. He's my oldest, and was getting older and started to think about, well, where's he going to be when I'm not around anymore and my wife's not around? And so decided to focus a lot of time and energy on building special needs supportive housing for folks with autism over 21. And so that's not what, my old company did. They were high-end residential, high-end office and life sciences. And so left there, took the summer off, goofed around, started working at Duane, and have been focusing in for the last 10 years on development type transactions. I do a bunch of sustainability and energy as well, but development is kind of where I spend most of my time. And a friend, kind of Christmas Eve of 2017 said, hey, you should look at this. And I'm like, nah, it's tax nonsense. Not interested. And he's like, no, I think you're going to be interested. Here's why. And that became kind of the opener to OZ kind of 1.0 and have been busy like you ever since, kind of helping investors, helping developers. I don't really represent the big funds that invest in the deals. My clients tend to create those deals and the funds tend to invest in those types of transactions. So a mixed bag of tricks of development, leasing, raising public debt, public equity. Having fun with it, enjoying it.
That's great. And thank goodness for that friend who brought you into this space. I'm glad he did, and glad to have you here in the Opportunity Zones industry, and especially here today on the show, Brad. Well, let's dive in. As many Opportunity Zone investors know, and in case you don't, we'll paint a picture for you. When you defer an eligible gain into a qualified opportunity fund, that gain is deferred until December 31, 2026. At the latest. If you have an inclusion event prior to that, or you sell your interest in the fund prior to that, that is the date of your gain recognition. But assuming you stay in through the end of 2026, that deferral is only good through December 31, 2026. That's the date that you have to recognize that initial eligible gain that you've deferred into a qualified opportunity fund. So, Brad, what does that mean exactly? And why does fair market value of your OZ investment on that date matter? How does it enter into the equation? Because we're suddenly getting to the point where, shoot, we're midway through, more than midway through 2025. People are now starting to think about that 2026 deferral date and when their taxes are due. So walk us through it.
I did notice you stumbled there for half a second and said shoot, so it was very impressive. Yeah, I think that you're right to be focusing now because as we get older, like time, we're gonna close our eyes and we're gonna be in like the fourth quarter of next year already. And so I don't want to say everybody, but many people have not really paid attention to the fact that everyone's kind of aware that for 1.0, OZ 1.0, we've got this 12/31/2026 date as you articulated, absent a sale earlier or an inclusion event earlier. And everyone's kind of benchmark that or put that on their calendar relative to, okay, I know I need to do something then. And with my 2026 return that I would file typically personally in, April or extended to October, I would need to have money set aside to pay for, the capital gain on my original investment into the fund. What people are not really focused on or haven't to date, to your point, is that the language in the statute talks about what is the gain on? Well, it's the lower of A, your investment. So how much money did you invest into gain eligible dollars into the OZ fund? Or, as you said, fair market value. Okay, so let's put that in real terms. So let's assume Jimmy had sold, back then Tesla, now Nvidia, and he had a nice gain. And he took his $1 million and he decided to invest $1 million into an OZ fund. The OZ fund then invested in an OZ business, in any of the zones in the United States, all 50 states, and et cetera. Okay, many of the projects have moved forward and they're fine, but many got caught a little bit in COVID world. So they got delayed or stalled or stopped altogether. Others realized that the place that they thought was going to be great wasn't so great. And they weren't able to really get construction financing, or they weren't able to raise all the equity that they needed, but they still own the property. So is that property worth what people paid for it back when they did it between 2018 and now? And if the answer is no, the property is not worth that. So let's assume, your $1 million came with 7 other people. So it was $7 million. Piece of land was purchased, and that land is now worth $5 million. So it's a $2 million deterioration in the value of the property. Well, is Jimmy required to pay on his $1 million investment? One would think, but it's the lower of the $1 million or the allocated value. So in that example, 7 became 5. We got to divide 5 by the 7 people that invested. Presumably, Jimmy's investment is worth less than $1 million. So he would only need to pay capital gains tax on the lower of what he invested or the fair market value. And so I think you're right to point out that this is something that people hadn't really focused on, I don't think, early on. Why? Because it's a long time in the future, and that's 26, and we're in 21 or 18. Now, all of a sudden, that's coming to roost. And to your point, it's important to think through what's it worth, and should the funds be providing that information to their investors? I would think, is that covered in their operating agreement? Maybe not. Typically there's some level of financial performance, balance sheet, income statement. Oftentimes, some of the documentation that we've collectively seen requires audited financials on a yearly basis. So at least there's some accounting involved. What would fair market value be and who determines it? Well, it's not Jimmy and Brad. If you're sitting across, when's this going to be relevant? It's relevant when you're sitting across an IRS agent. And so how is one going to be able to prove that the fair market value is less than their investment base? Well,
And you're going to want to use some valuation that is defensible in front of an IRS agent. So
absolutely.
let me pause you
Yeah,
there. I want to return to that in a
sure.
minute and get some thoughts from you on how to actually make that appraisal, how to actually
Yeah,
determine fair market value. But first, just to kind of get back to the basics, as you mentioned, it's the taxable gain that you recognize on December 31, 2026 is the lesser of the deferred gain or fair market value of the OZ investment. And then I would add in one more thing, minus your basis in the OZ investment, which we glossed
yes.
over at first, but I wanted to return to it. And what is the basis in the investment? Well, in most cases, it's zero unless you received one of those 10% or 15% basis step ups. You should receive a 10% basis step up if your holding period as of 12/31/26 is 5 years or more. You
Yep.
should receive a 15% basis step up, or you can take a 15% basis step up, I should say, if your holding period at 12/31/26 is 7 years or more. So if you got in prior to the end of 2021, you'll have a 10% basis step up. If you got in prior to the end of 2019, you'll have a 15% basis step up. So the lesser of the amount that you put into the QOF, the deferred gain, or fair market value, minus those potential, you either have a 0 or a 10 or a 15% basis step up. Is that right? Is my understanding correct there?
You are totally spot on. And so the way I like try to summarize that a little bit differently, but the same is folks talk about basis step up and we tend to lose some people there.
Yeah.
If you think about kind of if you invested in, 18 or 19, 2018, 2019, you're eligible for the 15% that Jimmy was talking about. If you invested in 20 or 21, 2020, 2021, you're eligible for the 10%. If you invested thereafter, you're not eligible for either of those. So what Jimmy's talking about is most people, if they invested after, 18, 19, 20, 21, they get nothing. And it's the same as what they invest, the lower of what they invested or the fair market value. For those who invested earlier, 18, 19, 15, 20, 21, 10, they will have basis to Jimmy's point. And so that will further reduce what they are required to pay capital gains on. So that's a great point and a good clarification for sure.
Good, because I didn't want anybody coming after us asking, hey, what
Yeah.
happened to my 15% reduction or my
I would say it's
10%
my little
reduction?
brother who said that. Yeah.
That's where that comes in. All right, so
Yeah.
let's return to the point I think you were about to make, Brad, which was, how do we make this fair market value determination on 12/31/26 such that it is defensible in the eyes of the IRS should you or the fund be audited at some point down the road?
So I kind of break that down, Jimmy, and that's again the right question. Because again, this is, some people are risk averse, some people are willing to take risks. This isn't really about that, although tangentially it is. It's about if you're sitting across from the IRS, what is it that you're going to want
Hmm.
with you, other than people, to support the notion that what you did was appropriate? Okay, so going and getting kind of stuff off of Zillow when you're sitting with the IRS agent, not such a good idea. Why? Because it's not contemporaneous with when you took the action, which would be 12/31/2026. Okay, so we're going to want valuation as close as possible to the end of next year. So would Zillow help? Well, it's better than nothing, but I wouldn't bank on that. Some folks have thought about, well, I have the assessed value. I went to the tax assessor and they gave me the assessed value. That to me is the worst thing. It's better than nothing, but not much because the assessed value really doesn't have anything to do with, for all intents and purposes, the fair market value of the property. It's an indicator, but it's not fair market value per se. So what would be better? Many brokers will do a broker letter of value. So it's not a full-blown appraisal, but it's their view based on what they've seen in the particular market and the product type as to what something is worth. So again, it's a third party. It's not the fund itself. The fund goes, engages somebody to look at the property and the surrounding properties. And, that's, I think, a good place. A better place would be to engage a true appraiser to go and look at kind of the three different values, kind of NOI, kind of what's going on in the past of the property, and they will give you an appraisal report. Like much like a bank would go when they are going to lend money, the bank will typically get an appraisal of that property to support the notion of what they're lending. And it's through an appraiser, an MAI appraiser, which is their trade association. Okay, and so best would be to have an appraisal, from December-ish of 26, showing what the value of the property is, whether it's land or land and building. Second best, in my view, would be kind of a broker letter of value. Third would be, print off everything you can find online about kind of property values around you. Fourth would be, kind of the day before you're about to sit down, which could be 3, 5, 7 years from now, depending on how quickly they came after you. That's not going to be contemporaneous. Again, so you could go back in time and try to figure it out, but that gets a little tricky. So to your question, I think getting a third-party valuation November, December of this coming, of 26 is the better way to do it. That way you have it in your file. If ever anybody comes calling, you've got the proof indicia of what it was, and that's what you relied on. It wasn't like you made it up.
And who? Yeah, that's great, Brad. And who should be taking the initiative to determine fair market value? Should it be? I think it's reportable by each individual investor in the fund. Yes. But I would imagine if you're in a larger institutional quality, professionally managed fund, that the fund ideally does it for you. Maybe if you're in your cousin's friends and family fund, he's not quite as organized, and maybe you have to go bug him for it. I don't know, but what are your thoughts there on who's responsible for getting this and delivering it to the investors?
Yeah, so I think what you said is right, meaning many of the investors are mom and pops who happen to have a gain that they invested with somebody that they trusted, whether it's friends and family or whether it's a more kind of organized fund. They should be looking to the fund, whoever the OZ fund manager is, to put this information together so that it's consistent for all the investors. Because you wouldn't want investor A saying it's worth one thing, investor B saying it's worth a third, different. Because then that would be a flag for the IRS that something amiss or something isn't. And so I think it would or should fall on the OZ fund manager or the QOZB manager to provide that information. That said, a lot of documentation that I've seen doesn't obligate them to do that. It says that they need to be in compliance. It doesn't say that they need to provide an appraisal or a broker letter of value. I think if asked, they would do that, but there's nothing obligating them to do that in a lot of the documentation I've seen. And so it will behoove the investor to make sure that the investor has something, because the investor is the one filing the return and paying the tax. And so the IRS is not going to come after the fund for all intents and purposes. They're going to come after the investor on their personal return when they make that filing. So our larger group of investors in all these funds should be thinking about, okay, has the thing taken off and we're doing fine and then it's my investment? Or has the thing not been built or it's not doing so well and it might be less? And if it's less, I want something in my file that from the OZ manager. At worst case, if they don't do it, the individual investor should do it, so that they've got defensible positions relative to why did they take this position vis-a-vis their own return. Make sense?
That does make sense. And this is ultimately reportable not at the fund level, but at the investor level. So this will probably get reported. Maybe if you don't know, that's fine. I'm speculating. I think this is probably going to get reported on Form 8997 for tax year 2026, or maybe Form 8949 is where you'll have to recognize it. Do you know exactly?
I think it's the 8997, but that's a little outside my lane, but I'm pretty sure it's the 8997. So, but you and I can look at that and we'll find that out and we'll report back to the collective. It makes sense that it would be on the 8997, but I'll check with the tax. I was going to say something else. Wizards.
Yeah, tax wizards will say. I like that. I'll call them tax nerds or tax geeks or something like that. But yeah, tax wizards is good too. Yeah, I think one way or another, you need to file it when you file your individual. Form 1040. It'll be one of the other 800
myriad
pages of forms that you throw in there. What's that?
The myriad of forms that go with it. Exactly.
Yes, exactly. So one or two of the forms will deal with this recognition issue at the deferral date of 12/31/2026. When you file your 26 return in April of 2027, that's when the liability will be due. Maybe your final filing won't actually be until October if you extend it, but the payment is due in April. Is that right? I
think that's correct.
For individuals? Yeah.
Yep.
You can't extend the payment, unfortunately.
Yeah. So again, that's another weird trick for the unwary, which is it's almost like paying your estimated payment. If you extend, you got to make an estimated payment. If one extended and you didn't know what this was, you're still supposed to make the payment. If you don't, you're subject to at least penalty for, April through October. So again, hopefully your accounting team is focusing you on that, but yes.
Good stuff. And then, we're talking about getting the fund getting appraisals or the QOZB getting appraisals of the asset. But is that the final number that is actually the fair market value of the OZ investment for the investor? Because the investor isn't directly holding those assets. The investor is holding interests or shares in the fund, right? So how does that break down exactly? Is it just merely pro rata what the assets are? Or is there more to it than that?
So at one level, it's just pro rata. So you could take the value of the property divided up pro rata. Where I'm hedging a little bit is if there's allocation of certain responsibilities or obligations so that one person's investment is disproportionate to others, there's impact to that. So it's a longer discussion than today. But for instance, if somebody guaranteed the debt, so an investor guaranteed the debt, do they get more of a distribution? So are they getting a preferred return? Are they getting an outsized distribution pro rata? How's that play into who owns what? That's where it gets a little bit trickier. So if it's just 5 friends and they invested, 1/5 each, relatively easy. If we've got like 200 people and a couple of people have guaranteed the debt and a couple of people have taken on responsibility for cost overruns, so instead of their pro rata share, they end up with pro rata plus, do they get more of an allocation, of the fair market value than what their pro rata piece is? The answer would be yes. You got to, again, to be able to defend that. So it gets a little bit hairy there on the appraisal will be of the property, and then the fund or the QOZB manager will need to then allocate that to the various and sundry investors. But most of the time it'll be relatively linear and it'll be pro rata most of the time.
Okay, good. And now, we're recording this in July of 2025. We're quickly approaching 2026 here. I mean, compared to when we started this whole thing in 2018, it was like, 26, that's forever. Now we're really closing in on it. So people are actually starting to come to me with these questions. They're starting to come to me, hey, Jimmy, what's going on here with 12/31/26? Do I still owe the tax on that date? What's this fair market value stuff? What should fund managers and investors be doing right now to plan for this? Are there any planning strategies that they can start to implement with regards to either at the fund level or at the investor level with regards to determining fair market value, first of all, and then coming up with the cash, with the liquidity to actually pay that liability in April of 27?
Yeah, look, one hopes that people have been planning since they invested. Again, in the beginning, there was a lot of ballyhoo about, well, we'll get approvals, we'll build. By the time this comes around, we'll be cash flowing and you'll use cash flow to pay for, your gain. Okay, that happened in some, but I would say the majority, maybe it didn't. And so hopefully those investors have been paying attention that they need to write a check after 12/31/2026. Again, selective hearing, like I get accused of, at least in my house. People hear what they want to hear, but that is the reality. So to your point, the investors and their tax planners should be or should have been, and if they haven't, they should be now, planning for end of next year with the next year's return, call it April 27, that making that payment. So at worst, it's what did I invest times my ordinary or times my capital gains rate. If we can get better and it's 15 or 10% down because of the 18, 19, 20, or 21, even better. If we got, this fair market value situation that's relevant, okay, at worst, plan for your investment, then you have more money than you're going to need. So that planning should have been going on throughout, but if it hasn't, you got a year and a half to sort of get that together, get your cash together that you're going to need in order to make that payment. Some would say, well, that's unfair. It's actually very fair. Why? Because you should have been making this payment back when you had the gain. It was the OZ that allowed you to defer until 12/31/2026, but people tend to sort of forget that.
Yeah, there
So
was an interest-free loan from
yeah,
the Treasury
from the federal
Department
government.
for a number of years in some
Yeah,
cases.
100%. That's absolutely right. It's a good way to look at it. So I think the planning piece is now, if you haven't already planned for it. On the fair market value piece, it might be a little bit early, but maybe not, because I think it's going to get a little bit frothy towards the fourth quarter next year, when all of a sudden a lot of people are going to be calling the same people to do these fair market value analyses. And so I would start to line up, maybe not, it's not now, but like September, October, November, when people are back from vacation, or I would start to call around and get pricing. What does it cost to do an appraisal? Depending on how complicated the thing is, it's a couple $1,000s to $20,000. So who pays for that? Is that in the fund document? Is that a capital call to get that done? Get that lined up in the fall so that you're ready next year and you're in line and you don't have to be running around. That might be a little bit early, but not really. So I think that there's plenty of appraisers, but find the one that you like, that you feel comfortable with, that they understand your property, I think will be the sort of call of the day. So
no, that's all great advice. Are there any tax mitigating strategies that either the fund or the investor can use to optimize their fair market value of their investment? Because for tax planning purposes, you want that to show as low a number as possible, obviously, right?
It's almost
but
like
you don't want
optimized.
it. Of course, you want to avoid abuse. But are there any tax planning strategies you can do you know of, to minimize your 2026 tax liability?
So you hit it a little bit, which is we don't want to maximize it. In an unrational world, you want to minimize the fair market value because then you're paying less tax on that. So you want somebody who's not overly aggressive, that's defensible, but understands that that's where you're trying to get to. I haven't really thought it through, Jim, but I'll play around with it on, would it make sense to sell on 12/29 the property, because then you establish fair market value. So as long as you don't jury rig this, sell the property on 12/30 for X dollars. Well, that will establish what the fair market value is. If you do that, you have 12 months to redeploy your dollars, if they don't get distributed to the investor, into another fund. I haven't thought through, does that help me in this instance or not? It would help in that you have established what the value is, I think, and you might be able to buy 12 months time rather than the payment time. But I want to think about that. Like that, I'm doing that off the top of my head.
Okay, we don't want to go down that rabbit hole, I think, but that's because we don't want to open up that can of worms right now. But
I don't think so.
Keep thinking about that one. I like that strategy potentially, but I guess I would just caution everybody that this does seem to be an area of Section 1400Z-2 that is ripe for abuse. So the IRS will be taking a close look at this in some instances, I would guess, if you try to push the envelope too much. So.
I think that's 100% true. In particular, if you're creating the market for the sale versus if you got a third party offer in, okay, and it was unrequested, not requested, okay, then that's one thing. If all of a sudden you decide, well, you call friends and family, I'm looking for somebody to buy this for $15 by the end of the year, that's obviously not going to pass the smell test. So you're right to, I think, point out that if you create the situation that where you're tax avoiding, the IRS will not be happy. And that's where they will focus energy and attention. Will they tend to focus on the larger dollar figure deals? I think so. I don't think they have the resources to deal with everybody, but that doesn't mean you shouldn't do it the right way. And so I think that your caution is warranted. People should be paying attention to make sure that it not only fits within the kind of four corners of what the words say, but the spirit of what they're asking for as well.
Absolutely.
Makes
Now,
sense.
now this whole conversation we've been having so far to this point, Brad, has been focused on OZ 1.0 investments, OZ investments made prior to the beginning of 2027. And I'm curious to hear your thoughts. What happens starting on January 1, 2027 for somebody who comes into what I've been deeming an OZ 2.0 investment, where they now have access to these new benefits under the law as signed by President Trump when he signed the One Big Beautiful Bill Act on the 4th of July of this year. So what changes for investments made on or after that date, Jan 1, 27?
So are you positing the trickier question, which is, what if somebody had a 1.0 investment and that 1.0 investment is still deemed to be in the OZ after 1/1/27 and new dollars come in after 1/1/27? Is that what you're asking, or are we building to that?
No, I'm not even building to that. I'm just asking
Okay.
you the very simple version of that
Simple
question.
one. Okay.
You've got a gain, you got a fresh gain. You've never
I
been
know
an
you're
OZ
tricky, so I
investor.
gotta be, you're a
Yeah,
smart
yeah.
guy thinking in three dimensions.
Don't
So,
make it. Let's not make it too tricky right now.
okay. So the basic premise is if we invest after 1/1/27, the reason I was probing Jimmy on that last question is new zones will be established in 2026 that will be available, applicable 1/1/27. So
Right.
Treasury and HUD will get together in 26. They will look at the demographic data. They will send that demographic data out to the governors of all 50 states. The governors will respond with, like, round numbers, 25% of the eligible areas for actual picking. And those 25% in those states will become the new zones in 2027. To Jimmy's question, if somebody invests after 1/1 or on 1/1/27 in one of these new areas, what do they get? Okay, well, it harkens back a bit to the old program with some modification. So what do they get? Well, they get a 5-year rolling deferral on their gain. So rather than under 1.0, it was a set date, 12/31/2026, what we've just been talking about. Whoever invests in the new program 2.0 after 1/1/27, whenever they invest, they get a rolling 5 years from their investment on their deferral. Okay, so they get a 5-year deferral versus if you invest today, you get until 12/31/2026, which is like a year and some change. So a little bit better on the deferral, 5 years versus a year and a half. Second, if you hold the investment for 5 years or more, you get what Jimmy referred to earlier as this 10% basis step up. In English, you only have to pay on the thing that you invested in. You get to reduce it by 10%. Okay, so if we invested $1 million, we get to reduce that $1 million by 10% or $100,000. So we're paying capital gains tax on the net. $1 million minus the 100 equals $900,000. Okay, that's the basis step up of 10% or a reduction off of what you've invested. Okay, what's eligible to be taxed. So again, first step, 5-year rolling deferral. Second step, after 5 years, you get a 10% basis step up. Third and fourth pieces, same as the first program. You hold for 10 years, you sell thereafter. Your sales price is not subject to capital gain, i.e., you've already paid on the original investment. So your sales price, the appreciated value, doesn't get taxed. In addition, there is no depreciation recapture, which is a good thing, for the OZ investor. Why? Because we now have new bonus depreciation rules that will directly affect OZ, and they'll directly affect all investors. But all investors outside the OZ will then have recapture when they sell. In the OZ, there is no recapture. So that's a big benefit to the OZ investor. They are going to get kind of sheltered income. And then when they sell, there's not going to be a recapture. So their returns will be better. All of what I just said, other than, is true. Okay, now I'm going to add to that, which is there's discussion in the new OB3, the One Big Beautiful Bill, about if we are investing in rural areas, that 10% basis, the step up, i.e. what I call the reduction, In rural areas, as defined under the new statute, it's 30%. So in my example, normally it would be 10%. So on a million, 10% would be $100,000. Well, if we're doing this in a rural area, it's 30%, meaning if we invest a million, 30% of a million will be $300,000. We would only pay on the net a million minus 300, 30% equals 700. So again, that's a big, could be, we'll see, a big driver of people re-looking at or looking at for the first time rural areas to invest in order to get that kind of basis step up. For a couple of basis points, I don't get too excited. For 20 basis points, yeah, that might be enough to drive some people to look at these rural areas where they might not have before. It's a little bit tricky as to where they are. Rural areas are defined as 50,000 people or less, but you can't be next to an area that was more than 50,000 people. So it's a little bit weird on how they define that. So it's like you can't be like a ring suburb of a big town, but you can be the second town, which is like, okay, I don't know where that came from. But
a brand new definition that doesn't comport to any of the maps that are currently available, unfortunately.
Yeah,
but
so
we'll get some guidance from Treasury on that, hopefully later this year is what I'm guessing. All right, so that was a great breakdown of OZ 2.0 and all of the benefits. We're almost out of time, Brad, but I did want to get back to fair market value determination with respect to OZ 2.0 investments, because once again, it's going to be the lesser of your investment in your deferred gain or fair market value of your OZ investment minus your basis. So in that case, I think what we're going to be seeing is, to your point earlier, we're going to see a flood of activity from appraisers in the second half of 2026, and then nothing for a few years. But then starting in 2032, which will be the first earliest deferral date for those first investors in OZ 2.0, and then we'll have that every year. By the way, I don't think it kicks out that deferral date to December 31 of that 5-year mark. It's just the 5-year mark. So you could have one investor who needs fair market value on January 1, 2032, and another investor who needs the fair market value on March 15th of 2032. So that might get a little bit messy. I'm not sure how we're going to, hopefully we get some guidance from the IRS on that.
I think you're absolutely right. Like you would have thought they would have said the end of the year in which the 5-year, but that's not what it says.
That's not what it says.
Look, your focus on this is spot on. I think that if I'm an appraiser, it's not like the, get rich quick scheme. But if I'm an appraiser, I would start to understand more about the OZ so that I could then go and market myself as an appraiser that I know how to do this. Because right now, everyone's going to be scrambling to find the right appraiser to understand what it is that we're asking them to do. Over time, that skill will develop. It's not hard. They don't have to change their methodology, but you need to find the right person. So if somebody was advertising themselves as, I've done 20 of these or 100 of these, I know what I'm doing, and here's the cost, I think that would resonate with people. So I think a cottage industry within the appraisal group will hopefully form, because people are going to need, as you said, this type of skill. It's not just for 26. It will be in particular, 33 and beyond on that, rolling basis. I think that's spot on.
Exactly. Well, Brad, it's been a pleasure speaking with you today. We're out of time. I got to cut you loose. But before we go, where can our audience go to learn more about you and Duane Morris?
Online. So you'll find me online. I'm in LinkedIn. I think it's Brad.Molotsky. Nothing too tricky there. Duane Morris has a website. I blog there I think it's under OZs. There's a bunch of blog posts. You can look at, whatever to your heart's content. But my thing is under OZs. I do some stuff on public-private partnerships and some stuff on energy. So feel free to check out DuaneMorris.com. Feel free to check out, my nonsense on, LinkedIn. All good. Jimmy, I'm not concerned. I'm curious. What football stadium is behind you over your right shoulder?
Oh, that back there is Notre Dame Stadium, my alma mater. So,
did you play football there?
I did not play football. No, I'm as that groundskeeper said to Rudy, I was 5'0", 100. So I did not play football, but I was a big fan. I still am to this day. Go Irish, right? Yeah. Well, Brad, thanks. We're out of time today. To my audience, thanks for watching and listening. If you enjoyed today's episode, give us a thumbs up, hit that like button. And if you want more information about Opportunity Zone investing, be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. I'll also have show notes available for today's episode on our website. Just head over to opportunityzones.com/podcast. I'll be sure to link to all of Brad's nonsense from there. Brad, thanks again for joining me today. It's been a pleasure.
The pleasure has been mine. Great to see you. Great to learn about Notre Dame. I was not aware of that. So now I know, go Irish.
Go Irish.
Yeah, man. That is one of the stadiums on my list to get to that I have not been to. So
we gotta get to there sometime. Thanks again, Brad.
Perfect. Great to see you, man. Take care.